The following slides include information from the balance sheets of Home Depot, Lowe's, Apple, and IBM for the 2017 fiscal year. Comparing dollar amounts of total assets for these companies may be misleading as their size varies. By converting the liabilities in stockholder equity to common size, a side-by-side comparison is possible. As a percentage of total assets, Home Depot reports 89.9% liabilities and 10.1% stockholder equity. Lowe's reports 81.3% liabilities and 18.7% shareholder equity. Apple reports 64.2% liabilities and 35.72% shareholder equity. And IBM reports 84.47% liabilities and 15.3% shareholder equity. In terms of total cash, these companies also exhibit wide variability when comparing dollar amounts, with Home Depot reporting $2.5 million, Lowe's reporting $500,000, Apple reporting $20.2 million, and IBM reporting $7.8 million. However, by converting total cash into a percentage of total assets, one can more easily compare these companies. Home Depot has 5.9% of total assets in cash, Lowe's has 1.6% of total assets in cash, Apple has 5.4% of total assets in cash, and IBM has 6.6% of total assets in cash. As a portion of current assets, Lowe's level of liquidity may come into question with such a low level of cash on hand. Additional information from a current ratio will be an important measure to consider. The same is true of net PPE for each company. As a percentage of total assets, Home Depot has 51% of total assets in PPE, Lowe's has 57.9%, Apple has 9%, and IBM has 9.2%. The difference in PPE between these two sectors is common, as Lowe's and Home Depot must operate brick-and-mortar retail stores, whereas tech companies such as IBM and Apple require much less investment in PPE. By examining each company's statement of cash flow statements, further comparison can be made. The operating cash flow of Home Depot is $9.7 million, Lowe's is $5.6 million, Apple's $63.5 million, and IBM's is $16.9 million. As a percentage of revenue, Home Depot reports 10.3% operating cash flow, Lowe's reports 8.6%, Apple 27.7%, and IBM 21.2%. Each company is demonstrating positive cash flow from operating activities, indicating net cash inflow as a result of transactions with customers. Investing cash flows for each company analyzed are as follows. Home Depot reports a negative $1.5 million or 1.67% of revenue. Lowe's reports negative $3.3 million or 5.17% of revenue. Apple reports negative $46.4 million or 20.26% of revenue. And IBM reports negative $10.9 million or 13.73% of revenue. According to this data, Apple and IBM far exceed Home Depot and Lowe's in terms of investing cash flow. This outflow of cash is not necessarily negative for a company, as it may indicate the purchase of additional PPE, intangible assets, stocks, bonds, or other securities. This may paint a strong picture of a company investing in maintenance and growth of its infrastructure with capital expenditures. The final analysis from the statement of cash flows comes from financing cash flow. Home Depot reports a negative $7.8 million or 8.32% of revenue. Lowe's reports negative $2 million or 3.23% of revenue. Apple reports negative $17.3 million or 7.57%, and IBM reports negative $5.7 or 7.25%. The cash outflow related to financing may be related to payments or dividends, payments to acquire treasury stock, or payments to settle outstanding debt. Returning cash to shareholders through dividends is a healthy sign of cash outflow in regards to financing activities.